Yes, we want to thank you all for coming. All kidding aside, we know this is a free event monetarily, but it is certainly not free in terms of your time. So we do plan on using your time wisely. Here's the deal. I logged on early and I called Julie and Megan talking about me, saying Pete's lectures, he goes forever. He never shuts up. That's what they were saying. They didn't know I had logged on already. So this is scheduled for 2 hours. I'm going to try 2 hours, but it may be, I don't know, maybe 3 hours. But the goal is, I don't know, 2.5 hours. That's what we're going to try. All right. There's a high probability, though, we'll be in the right tail because I want to give you free value. But look, all kidding aside, this is going to be recorded and taped so you can view it again on demand. Obviously, I want to go slow enough that you can understand what it is I'm doing, but at the same time, I want to cover 2 beautiful task-based simulations on the back end after I go through some of the basics. So if there's anything you missed along the way, no worries, because you'll get the recorded version of this. What I'm going to do today is twofold. The first thing I want to do is kind of show you what our notes look like. So that whole process of how we teach the concepts. We're a big believer here, although we're called a review course, truth be told, we realize a lot of this is not a review. For whatever reason, there are certain topics on the CPA exam that you may not have done well in. You may not have covered it all, or maybe you got an A and you celebrated so long, so hard, you blacked out and forgot everything you learned. I don't know, but there's no presumption of prior knowledge. So we're going to walk you through exactly what you need to know. Part of our course, the pre-recorded lectures, we walk you through the content. Then we do a lot of problem solving, both in the pre-recorded lectures, but then we have what's called live online boot camps, where you can log on either live or on demand. But if you want to enjoy a live lecture just like you are here today, we have those periodically throughout the different sections of the exam, but that's all about application. Some of it multiple choice, but a lot of it task-based simulations, okay? So that's what I'm illustrating today. 2 of our tools, a little bit what the pre-recorded lecture looks like, walking you through the concepts, and then number 2, how we apply it in the live online boot camps, okay? So we're starting off obviously with consolidated financials. We have now accelerated to the point where we're looking at different types of investments. What precedes this lecture, when we talk about investments in common equity, there are actually different types of investments. Whoops. There are different types of investments in common equity. So when you buy stock of another company, you might buy a relatively small amount, less than 20%. You have no significant influence. In a separate lecture, we talk about accounting for that, what's called held for trading, or a trading security, or what they call around the world fair value through P&L. That's not part of today's lecture, but you always got to be mindful of, hey, how much influence do I have over this company, if any? If you see you own less than 20%, that's evidence that you're going to use the rules for held for trading, where dividends are income, okay? Dividends are going to be income, and you'll mark that stock to fair market value at the end of the period. Not covering that today. When you own between 20 and 50, that is evidence of something called significant influence, where you're going to use what's called the equity method of accounting. Now, folks, when you study, that equity method of accounting is so important. It's 2 for 1. First of all, if you don't have control, but you have significant influence, you got to learn how to do this thing called the equity method of accounting. Dividends are not income. You do not mark to fair market value. Instead, you're going to adjust your carrying value, which I'll show you how to do. But not only can they test equity method directly, but they can also test it indirectly through consolidations. When a parent company buys greater than 50%, and it doesn't have to be, that's only evidence, but in essence, you have control, then you're going to have to consolidate. What's interesting is, though, the parent standalone balance sheet and income statement, they're standalone. Before they combine with the subsidiary, the parent has to account for that investment using, again, this thing called the equity method of accounting. So make sure you have mastered the equity method. That I will review with you today, okay? So that's kind of step 1 in our process. So here we go. When do you have to consolidate? You have effective control. Okay, now one of 2 things could be true. Ownership stake, you own more than 50%, you've got a controlling interest, but that's not the only situation. You might own less than 50%, but nonetheless have effective control. Why? Because they call you a primary beneficiary, a variable interest entity, sometimes around the world, special purpose entity. But the bottom line is you look for the ownership stake, but that is only evidence. Read in the facts carefully, especially if it's a task-based simulation. You might only own 45%, but they say, hey, it's a variable interest entity. You are the primary beneficiary, that entity is. You're thinking, I got to consolidate. All right. Next step, they tell us on the exam, you ready? We've got common economic control. They're separate legal entities, but there's common economic control. So even though each company maintains their own standalone financial statements, we are eventually going to have to combine them. Why? Because the shareholders of the parent entity control that other entity. They control that subsidiary. So what we're going to have to do is, when they're under that common economic control, US GAAP requires the consolidation. So you're going to have the parent standalone financials. You'll have another exhibit with the subsidiary standalone financials. Our job is to figure out, how do we present those two separate entities as if they were one entity, okay? And then we're going to learn what those entries are to consolidate. So, you ready? Parent financial statements. The parent standalone financial statements, they're going to account for that investment in the subsidiary. Now we're going to focus in on today the equity method, as I've already mentioned, but technically they can use another method called the cost method. The cost method is really simple. The investment in subsidiary stays on the books at your purchase price, at your cost. It doesn't change. You don't adjust it. And dividends are income under the cost method. Unfortunately, today, we are not covering that. We are going to cover equity method in our abbreviated session in great detail. Under the equity method of accounting, when you see equity method, I want you to immediately think two things. Number one, do not mark to fair market value. Do not mark to fair market value. And number two, under this method, dividends are not income. Okay, so that's what we're going to focus in on today. The parent standalone financial statement, before we consolidate with the subsidiary's financials, we have to make sure that we've accounted for the investment in the subsidiary, if it's equity method, not marking to fair market value, and dividends are not income. Okay, so we're going to make a flashcard together right now. Under the equity method of accounting, you're going to have your beginning carrying value, that investment in the subsidiary. Okay, your price paid, your cost. Your price paid, your cost. That's our starting point. You're going to add your percentage share of the subsidiary's net income. And we're going to practice this. You're going to subtract your percentage share of the subsidiary's excess depreciation. We're going to focus in on that as well. Then you're going to subtract your percentage share of the subsidiary's dividends. This is how we are going to calculate the ending carrying value investment in sub on the parent's balance sheet. And we, again, do not mark it to fair market value, nor does it stay on your books at the original cost. That's the cost method. Okay, we're going to be doing equity method. Now, there are some additional subtle details, and we'll build on that, but that's our foundation, okay, that formula right there. You take these two numbers right here, your percentage share of the sub's net income minus the percentage share of excess depreciation. That's going to be called the equity earnings from the subsidiary, and that's what's on the parent's income statement, the parent standalone income statement. Okay, and we'll see how to do those journal entries, cover that in great detail, all right? But the first thing is you've got to know that equity method of accounting. Now, when we consolidate, you're going to learn two very important entries on how to consolidate. Number one, intercompany transactions are going to be eliminated. So intercompany transactions, we will eliminate. And then you're going to learn that the eagle is in, baby. The eagle is in. You are going to learn your journal entry to consolidate. That's all done on a worksheet, okay? And I'll show you a great task-based simulation on how sometimes that's done already, but it's done incorrectly. You got to find what they did incorrect, okay? What mistakes they made. But before you find the mistakes they made, you're going to first do it correctly, compare what should have been done to what was actually done, and then you can logically figure out, okay, how do I get from what was done to what should have been done? All right, great stuff here. So the consolidation process, you ready? We are going to combine. We are going to combine the assets and liabilities of both companies. Okay, 100%, folks, even if you buy only 80%, we're still going to combine the assets and liabilities of both companies 100%, okay? We're going to do our eagle in entry and our other intercompany eliminations. Okay, so first we're going to predominantly focus in on the balance sheet, then I'll show you what to do for the income statement, okay? But that's the consolidation process. That's what we're going to learn about right now. Okay, this consolidation process, the eagle in and the journal entries to eliminate intercompany transactions, folks, is not done on the books of either entity. It is done on a consolidation worksheet, okay? So the key point is here, folks, consolidation process. We are adjusting and eliminating balances. We want to show what the balance sheet and income statement would look like if these two separate entities were one single entity. But the key point is here, the elimination entries are done on a worksheet, not on the individual books of either company, okay? Both companies are keeping their separate income statement, balance sheet, etc. All right. Now, when we do the consolidation, there's generally one of two dates. You're either going to do it on the date of acquisition, on date of acquisition. So watch your dates carefully, on date of acquisition, or at a future date. So you've got to read carefully. Are we doing this on the date of acquisition, or are we doing this at a future date? All righty. If it's a subsequent date, folks, if it's a subsequent date, then you've got to do for me my beginning carrying value in that investment in sub. We're going to add our percentage share of net income minus our percentage share of excess depreciation minus our percentage share of dividends. And that's how you get your ending carrying value, okay, in the investment in sub. And then this is what needs to be eliminated, the ending carrying value. So if it's a subsequent date, not the date of acquisition, a future date, then you've got to make sure you're adjusting the carrying value for that investment in sub from the beginning balance to the ending balance, okay? And these two numbers combined, that's our equity earnings. You know how they like to mess with you? I'll add another piece of the puzzle. You ready? Watch your dates. We might have bought this company November 1st. Okay, that's the acquisition date. 2 months later, they ask us to do the consolidation. So we have all of November, all of December. When you add your percentage share of net income, you should only be adding 2/12 worth of that net income because you only own them from November 1st to the date of consolidation, December 31st. Same thing with the excess depreciation. You've got to make sure those numbers are adjusted for the date, okay? So that's assuming we bought them initially November 1st, and then they ask us to consolidate on December 31st. Dividends, you do not adjust for the date, okay? That's your dividends. You bought the company. You're going to get those dividends regardless. The date can be ignored, but your percentage share of net income and excess depreciation has to be adjusted for the number of dates you own them that year, okay? Assuming you bought them in year one, November 1st, we're consolidating December 31st, year one, okay? And we're going to see how to do that. All right, your purchase price your purchase price. There's 3 ways we can acquire a company. Cash can be paid. If so, parent cash goes down, so consolidated cash is going to go down. That cash does not stay within that consolidated group, folks. It doesn't. It goes to the shareholders of the subsidiary that were bought out. So if they pay cash, parent cash goes down, consolidated cash goes down. They might issue debt, sign a promissory note. If so, then on the parent standalone financial statements, the parent liability goes up, which means consolidated liabilities will go up as well. And sometimes you'll issue your stock for their stock. So if we pay with stock, tell me the fair market value of the stock. Parent equity will go up, both stated capital and additional paid-in capital, which means consolidated equity will go up with it. So always note how we financed that acquisition. Did we pay cash? Did we issue debt? Or did we issue our stock for their stock? Okay, so a lot of moving parts here. And when they ask you to consolidate, is it on the date of acquisition or is it a subsequent date? Do I need to adjust and find my ending carrying value? Okay, so that'll all be dictated by the factors we're going to see. Another thing is, note what percentage we own. If you own 100%, there's no non-controlling interest. When you buy all the stock of the other company, you buy all of it, obviously there's no minority interest. But if you own less than 100%, then be mindful. Let's say you purchase 75%, then you got to take 1 minus 0.75, 25%. That is my non-controlling interest, also known as your minority interest. That is your non-controlling interest, that 25%. I need to know what is the fair value of that non-controlling interest. And I'll show you there's 2 methods to come up with that fair value. Okay, so did we buy all the stock or only some of the stock? Consolidated equity is always the parent equity plus the non-controlling interest, plus the non-controlling interest. Now, there's going to be a beginning non-controlling interest at fair value, but that non-controlling interest, that adjusts over time as well. Add your percentage share of the subs net income, 25%, minus your percentage share of dividends, 25%. You're going to have an ending non-controlling interest. It gets adjusted. So when are we consolidating? Is it at the beginning of the year upon acquisition, or is it at the end of the year? The non-controlling interest, like the investment in the subsidiary, gets adjusted over time. It gets adjusted over time. Okay, so we're going to learn how to do that. And that's why the date is so important. When are we consolidating? Immediately upon acquisition or at a subsequent date, a future date, as we'll see. Okay, preparing those consolidated financial statements. You ready? 2 things we have to do. 2 things we have to do. Number 1, we've got to eliminate intercompany sales, receivables, payables. I'll show you how to do that, all the different types of transactions. And then number 2, we've got to do our Eagle in. Here's your date for tonight. Whatever you were going to do, cancel those plans. You're going to do this instead. You ready? The equity of the subsidiary, the book value, and that could either be at the beginning of the period or end of the period. It all depends upon the date of consolidation. There's your E. Assets. If there are assets where the fair value is greater than the book value, that's where we will add that differential. Goodwill. That is not on the parent's books. It's not on the parent standalone books. This has to be inserted on the consolidated balance sheet. And we do that on the worksheet. We're going to include our goodwill. If there's any liabilities where the fair value is greater than the book value, we'll make that adjustment. There's our L in Eagle In. The investment in the subsidiary account, whatever that carrying value is, that's got to be eliminated. And then our non-controlling interest. Non-controlling interest. Okay, that's got to be part of consolidated equity, all right? All I need to know is, when is this being done? What date? Is it the date of acquisition? Or is it at the end of the year? A different day, okay? A future date, because that'll tell me what carrying value I need for the equity, what carrying value I need for the investment in sub, what carrying value, and this should be book value, end of the period or beginning of the period. So all of those amounts are depending upon the date, okay? So what's the appropriate carrying value? Beginning of the period or end of the period, as we're gonna say. All right, so we got the parent standalone financial statements, income statement, balance sheet, the subsidiary income statement, balance sheet, okay? We're gonna combine the assets and liabilities 100%, even if parent owns less than 100%. Even if they own only 60%, we're still gonna combine 100% of the assets and liabilities. The 40% that is not owned by this consolidated group will be segregated. That will be part of consolidated equity. We got to do our elimination entries. That's our Eagle In. That gets done on the worksheet. Easy multiple choice. Does that get done on the parents' books? No. Subsidiaries' books? No, it's done on a worksheet, and then we prepare our consolidated financials. Remember to eliminate intercompany transactions. It could be a sale of inventory. It could be a sale between the companies of PP&E. It could be a sale of bonds between the company. We are going to review all three of these common transactions: intercompany sale of inventory, intercompany sale of PP&E, intercompany sale of debt. I'll show you how to do those elimination entries as well. Okay, so ultimately what we want to show the world, what if they were one entity? What would their financial statements look like? You can't sell to yourself. You can't lend to yourself. So we want to eliminate those intercompany transactions, okay? So the consolidated balance sheet will be different from the parent standalone financial statement. On the parent alone balance sheet, pre-consolidation, we have one line item. It's called investment in subsidiary. That's it. It's called one line accounting. That's all we got on the parent standalone balance sheet. All we have is one line, investment in subsidiary. Whereas on the consolidated balance sheet, we show 100% of both companies' assets and liabilities, 100%. And then any non-controlling interest, if there is any, is going to be part of consolidated equity. This doesn't seem like a big deal, but folks, in the real world, consolidated assets are going to be greater than the parent alone assets. Consolidated liabilities are going to be greater than the parent alone liabilities. Consolidated equity is always going to equal the parent equity plus any non-controlling interest. This is really important in the real world when you do ratio analysis, okay? Net income, the parent net income is exactly the same as consolidated net income. When you consolidate the income statement, the parent net income is going to be the exact same thing as the consolidated net income, bottom line, but with greater disclosure. Instead of just showing the parent sales, the parent expenses, and then one line item, on the parent alone, we have something called equity earnings. That's it, one line accounting. That's all we have. Whereas with consolidated net income, we have combined sales, combined expenses. All righty. Now, your ultimate bottom line is going to be the same, but with much greater disclosure. You get to see both companies. So, for example, in the real world, how do you judge a company's performance a lot of times? Profit margin, right? So if you take a look at something like net income divided by sales, net income doesn't change, whether it's the parent standalone net income using the equity method to account for the investment in the subsidiary, or combined consolidated net income, the numerator doesn't change. But folks, when you combine the sales, rather than having in the denominator just the parent sales, if you combine the sales, all of a sudden your profit margin doesn't look as good as it did before when the parent standalone income statement just had one line item called equity earnings and affiliate. All of a sudden the profit margin doesn't look so good. Return on assets, another very important metric in the real world. Okay, your return on the investment in the asset. Net income doesn't change. Parent standalone or combined, same numerator, but the denominator is going to change dramatically. You see, rather than having a single line item called investment in subsidiary, now let's eliminate that. And instead, let's pick up 100% of that subsidiary's assets and liabilities. All of a sudden, you got a much different denominator. Your return on assets is going to look very different, not nearly as impressive, okay? So the parent standalone financial statement can be misleading when you use the equity method of accounting. Nothing illegal or unethical, but it doesn't give a proper picture of what the performance is, what the return is, what the risk is. Okay, now, consolidated income statement, statement of retained earnings, statement of cash flows, okay? Much greater disclosure. Okay, bottom line might be the same, okay, but consolidated financial statements provide greater disclosure than one line accounting under equity method. So even if the bottom line net income doesn't change, we want that greater disclosure to better assess risk, performance, whatever. Okay, so on the parent alone income statement, we have one line item. It's called equity earnings. Equity earnings. Versus the consolidated income statement, we have combined sales, 100% of both companies, even if you don't own 100%, minus your combined expenses, 100%, and then minus the income that's going to the non-controlling interest, not part of this consolidated group. Okay, any income that's going to be allocated to the non-controlling interest, that gets subtracted when arriving at consolidated net income. And that's going to be the exact same number as the parent standalone net income on their own income statement, but much greater disclosure. Okay, so rather than just the parent expenses, parent revenue plus equity earnings minus just the parent, no, that doesn't give me the detail I'm looking for. All righty. Now, be mindful. If you consolidate on the date of acquisition, there's not going to be any earnings, any cash flow, any change in retained earnings. So on the date of acquisition, immediately following the acquisition, the only financial statement that has to be consolidated is the balance sheet. Why is that? Because there's been no activity yet, no cash in, no cash out. There's been no sales and expenses since the acquisition. So the balance sheet is fundamentally different because it's cumulative. All righty. As of the date of acquisition, the subsidiaries had no activity yet, right? There's only going to be activity going forward. All righty. Now, the method You ready? The method the parent uses to account for the investment in subsidiary. That doesn't matter if we're doing it immediately following the date of acquisition. Cost method, equity method is exactly the same because there's no activity yet. No activity yet. The investment in subsidiary, their purchase price, that's going to be the carrying value of the sub, whether you do the equity method or carrying value of the sub if you do the cost method. It doesn't matter. There's been no activity yet. Okay. Again, we're not covering cost method today. There's not enough time, but under the cost method, that investment in subsidiary account doesn't get marked to market value, and we don't adjust the carrying value like we do under the equity method. They call it the cost method because basically the investment in subsidiary stays at whatever your purchase price was. Not true under the equity method. As the subsidiary has revenues, expenses, has activity, as they pay dividends, the carrying value changes under the equity method, not the cost method. Okay, dividends under the cost method are income, not under the equity method. Under the equity method, dividends reduce the carrying value, okay? Not a big deal, but there's no time to go into great detail here with that. We're gonna focus in on the equity method, same thing the exam focuses in on. Now, after the date of acquisition, that's where you gotta be mindful of cost versus equity method. How is the parent accounting? How is parent accounting for investment in subsidiary? Okay, under the cost method again, carrying value, no change, stays at cost, stays at cost. Dividends are your income that has to be eliminated, okay? Under the equity method, carrying value is gonna get adjusted. Dividends are not income. Your income are those equity earnings that I showed you earlier that we'll review again. All righty, so very important you read carefully on the exam. We're focusing our time on equity method because that's where most of the questions are likely to be. Cost method's not a big deal, okay? We're just gonna focus in on equity method. Parent standalone financial statements are not GAAP compliant when there's another entity you control. When you control another entity, what do we gotta do? Consolidate all subsidiaries under their control, okay? Now, after the date of acquisition, there's activity. The subsidiary is going to have revenues, expenses, gains, losses. Dividends could be declared, paid. This is where cost versus equity is really important. All righty. So let's take a look now. Investment in subsidiary on the parent's books. Cost method stays at cost. Your original purchase price paid. We're focusing in on equity method. Investment in subsidiary gets adjusted over time. Do not mark to fair market value. Do not mark to fair market value, okay? And I'm not dealing with that, you know, if it's permanently impaired, that's a different story. We don't have that here in Consolidations, okay? Don't mark it to market value, gotta be distractor information. And that ending carrying value is gonna be different than the beginning carrying value, as you're gonna see. Okay, so equity method, you ready? The more times you write it, you hear it, you read it, you'll remember it. So write it with me, you ready? We've got our beginning carrying value plus our percentage share of net income minus our percentage share of excess depreciation minus our percentage share of dividends. That is the ending carrying value. Do not mark it to fair market value. That is the ending carrying value. These two numbers here, that's going to be called the equity earnings. Equity earnings. That's what you see on the parent alone income statement. We're going to want to eliminate that and instead include 100% of the revenues, expenses, gains, and losses. That's how we do the equity method. Okay, cost method stays on the book at original purchase price. There's no excess depreciation recorded. Dividends are your income, not your percentage share of the company's net income. Alrighty, so it stays on your books at original purchase price. Journal entries. You ready? We start with your investment in subsidiary, your original cost. That is your beginning carrying value, year one. That's your beginning carrying value. Okay, then we're going to add our percentage share of net income. What's the journal entry? We're going to take our percentage share of the subsidiary's income. We're going to debit the investment in subsidiary, carrying value goes up, and that's called equity earnings. That's on the parent standalone income statement, equity earnings. So this is what you will see on the parent income statement, standalone. The parent's share of dividends, what's the journal entry? Either you got the cash or you have a receivable, okay? And notice, that makes the carrying value go down, okay? So minus our percentage share of dividends. And then amortization, depreciation, any excess of fair value over carrying value. Equity earnings, that makes the parent's earnings go down, and that makes the carrying value go down. So our percentage share of excess depreciation, that makes our carrying value go down. This is how you find your ending carrying value for the investment in the subsidiary, along with the journal entries, okay? Along with the journal entries. Just watch your dates, okay? Watch your dates. This may have to be adjusted. The number of months over 12 if we bought them during the year. Number of months over 12, as you'll see. Dividends are not affected by the date of acquisition. Okay, whatever the dividends are, we're entitled to them. We bought the company. It doesn't matter what date we bought them. Okay, those dividends are ours in their entirety. But your percentage share of net income minus your percentage share of excess depreciation, you got to watch your dates. All right, finally, show me an example and away we go. Passing company, that's you, because you're with the right company. They purchased 100%. As soon as I see that, what do I think? Control. What else do I think? No, non-controlling interest. They bought them for $200,000 on January 1, year 2. So watch your dates. Beginning of the year, we bought them. So if we're going to do something at the end of the year, 12 over 12, 12 over 12, because we own them the entire year, if we're doing something at the end of the year. Okay, they tell us on that date, 150,000, carrying value of S equal the fair value of all their assets and liabilities, except for equipment, which had a fair value of 100,000 and a book value of only 80. Stop right there. The PP&E, you ready? The fair value was 100,000, yet the book value was only 80,000. So the fair value over the book value for that asset is $20,000. That's the first thing I want to make note of. They tell me any additional excess purchase price is attributed to goodwill. We'll deal with that in a second. The equipment has a remaining life of 4 years. Take that excess fair value over book value. We are going to write that off over a 4-year period of time. So what's that going to be? 20,000 divided by 4 years, $5,000 per year is going to be what we call our excess depreciation. Now, folks, watch the way I do this. Very important. You ready? What was the purchase price for this company again? Our purchase price for 100% of this company, 100%, $200,000. What's the fair value of the non-controlling interest? Well, 0%, that's a 0. So what's the total fair value for 100% of this company then? $200,000. What was the book value of the equity? Let's start there. What was the book value of the equity? Well, the fair value and the book value are the same except for that one piece of equipment, okay? So the book value of my equity is $150,000, okay? Excess over book value. Why did we pay an extra $50,000 above book value? Why? Why did we pay an extra $50,000 over book value? Well, some of that I can identify. The identifiable excess is the PP&E that has a fair value over book value of $20,000. Okay. Why did we pay this extra $30,000? I have no idea. This is unidentifiable excess. I have no idea why you paid that extra 30, but we can't have something called I have no idea. So what do we do instead? We're going to call it goodwill. We call it goodwill, but it's really I have no idea. All right. So that is how you're going to calculate your goodwill. Or another approach, purchase price for 100%. $200,000. The fair value of the non-controlling interest is 0%. I know that seems silly, but I want you to get in the habit of doing it this way. Total fair value for 100% of the company, $200,000. Less the fair market value of the identifiable equity. If the book value of the equity is 150 and we have assets, fair value of the asset greater than the book value of the asset by $20,000, that means the fair value of the equity's got to be $170,000. That is another way to arrive at your goodwill. Same result, different format, depending upon the way they present the facts. Okay? So, upon acquisition, what is my investment in this subsidiary? Upon acquisition, journal entry number 1, on January 1, year 2, we're going to debit investment in subsidiary. For our costs, what did we pay? $200,000. And how did we pay for it? Let's see. We bought 100 and it doesn't say anything, so I'm just going to assume we paid cash, $200,000. What happens to the parent's balance sheet? What happens to the parent's balance sheet immediately after this acquisition? Cash goes down by 200, investment goes up by 200. No change to total assets, only a change in form. We're less liquid. Instead of having cash, we now have this investment. No change to debt, no change to equity. All righty. Now, look at this. During the year, the company earned $50,000 in net income, and there were no dividends. And there were no dividends. Folks, what I want you to do, whoops, sorry about that. I want to put in a slide here, a new slide, new slide, new slide. Let's get a blank slide. Where's the blank slide? Blanks, there we go. You ready? This is what I want you guys to do. So the sub had net income of $50,000 and there were no dividends. You ready? We had our beginning carrying value at January 1, year 2. Our cost. What did we pay for this company? $200,000. Plus our percentage share of net income, $50,000. What percent did we buy? 100%. And how long did we own them? The whole year, $50,000. Minus our percentage share of excess depreciation. Remember, there was that $20,000 fair value over book value. We were depreciating over 4 years. $5,000 excess depreciation, $5,000 times our percentage share. And again, how long did we own them? The whole year, minus $5,000. Minus our percentage share of dividends. Ignore the dates, 0. What's our ending carrying value under the equity method of accounting? What is our ending carrying value at December 31? Year 2, our ending carrying value, $245,000. What's our equity earnings on the parent standalone income statement? They would have a line item called equity earnings. And how much would that be? $45,000, the 50 minus the 5. Those two items you summarize, there's the equity earnings in the affiliate. That makes the parent net income go up on the parent standalone income statement. Okay, but we have no idea what drove that $45,000, no clue, because we don't see the sales and expenses of the subsidiary until we consolidate. All righty. Now, you ready? Purchase price again. You've got to be able to allocate the purchase price the way I did it already. How much of that is attributable to the book value of the equity you acquired? In our case, 100% of the $150,000 book value, $150. how much is allocated to the fair value over the book value? Well, in our case, it had a book value of, what was it? It had a book value of 100, but book value of 80, but a fair value of 100. That was a plus 20. And then that $200,000 purchase price, well, what portion is unidentifiable? Excess that we cannot identify, goodwill. That's goodwill, 30. So that's got to now reconcile, and now you understand why the company paid $200,000. Some of it was due to the book value of the equity. Some of it was due to the extra $20,000 getting you to 170. 30, no idea. 20, I understand. But the excess over book value, why? So the 200 minus the 150, we want to be able to allocate how much of that is unidentifiable versus how much is identifiable. That's identifiable excess. Goodwill, I have no idea why you paid the extra 30,000. Okay. Now, to consolidate, you ready? If we're going to consolidate the balance sheet at year, why am I screaming at you guys? Because I am freaking excited. I'm looking at all you guys. You guys are going to pass. Not just pass, you're going to kick ass. Okay, you ready? So, consolidated balance sheet at year end. You ready? Let's consolidate that balance sheet at year end. So let's see. So let's do it. So where was my ending carrying value? There we go. There's my ending carrying value. Okay. So I want to consolidate now at year end. First thing I need, my Eagle in. EAGLIN. Okay. Book value of the subs equity at year end. Folks, that was not given. I don't know. They didn't give that to me explicitly. Okay, they didn't. My beginning book value of the subs equity was given as $150,000. That was given information. Year end, they didn't give that to me, although we're going to be able to figure it out, as you're going to see. Okay, the assets, fair value over book value. Okay, that was $20,000 minus any excess depreciation we recorded that year. How much excess depreciation did we record? $5,000 worth. That is this number right here. Okay, so we're going to put that asset on the books at fair value less any excess depreciation, $5,000. So that's $15,000. How much goodwill did we record? We said the goodwill was $30,000. Were there any liabilities where the fair value was over the book value? Zero. What's the investment in subsidiary at the end of the year? Whoops. Whoa, that's a big head. Investment in subsidiary at year end, what did we say that was? $245,000. $245,000. The non-controlling interest at the end of the period is zero. We own 100% of the company. Now check this out. My credits add up to what amount? 245. That means my debits have to add up to what amount? 245. So our plug figure, what's got to be the book value of the subs equity at year end? It's got to be $200,000. That's your plug figure. How do I know that? Because my debits and my credits have to equal. Now check this out. Why would my year end book value of equity be 200,000? Why would it be 200,000? What changed in the subsidiary's equity? Paid in capital did not change. They didn't issue any more stock. They didn't buy back any stock. So that didn't change, but they had net income this year. That makes your retained earnings go up. That makes your equity go up. And your dividends were what amount? Zero. Our dividends were zero. So 150 plus the change in paid in capital, there was none, plus the current year net income minus the dividends declared zero. 150 plus the 50, year end 200,000. We're in good shape. So we have two ways to find the equity of the subsidiary at year end. Either we could plug it by doing our eagle in, or you analyze what would come. Now, look, your change in equity is going to come from one of three things. Anytime you have a change in equity, anytime we have a change in equity, oh, it's not allowing me to add a slide. Okay, no problem. Anytime you have a change in equity, it comes from one of three places: change in paid-in capital, change in paid-in capital, change in retained earnings, or change in accumulated other comprehensive income that doesn't apply here. For consolidations, that's where it's going to come from, the change in retained earnings. All righty. Our investment in sub, what was our beginning balance? 200,000. What makes it go down? Our share of dividends, our share of excess depreciation makes it go down. What makes that investment in subsidiary account go up? Our percentage share of the net income, and there's your ending balance. Okay. The equity earnings. You ready? Where did we get our equity earnings from? Our share of their net income, 100%. What makes our equity earnings go down? Excess depreciation, that fair value over book value, divided by 4 years, 5,000 times our percentage ownership, 100%. 45,000, that was our equity earnings in the affiliate. This is what you would see on the parent alone income statement. You would see equity earnings, $45,000. What would we see on the parent alone balance sheet? Investment in subsidiary. That's it. All righty. Goodwill is not on the parent balance sheet. Goodwill only appears, goodwill is only on a consolidated balance sheet. It's not on the parent standalone. The only thing that's on the parent standalone balance sheet is investment in subsidiary, beginning balance and then the ending balance. Okay, investment elimination. Let's do it, baby. Here's your eagle in. Book value of the sub's equity. We could break that down into 3 pieces, but this is the E in eagle in. You got the common stock, the additional paid-in capital, the retained earnings. All 3 of those have to be eliminated. The book value. Okay, any identifiable assets, fair value over book value, fair value over book value, net of any excess depreciation. Net of any excess depreciation, as we've seen. There is your A in eagle in. Goodwill. Okay, whatever that amount was that you calculated, you got to put that in there. Identifiable liabilities if the fair value is greater than the book value. By the way, that gets credited, obviously, right? If you want to increase the liability, it's with a credit. Your investment in subsidiary, and then, folks, your non-controlling interest, if any. But do me a favor, when you review, I don't care if there's non-controlling interest. Put it in anyway. Always review your formulas in their entirety. So let's try another question. Pair requires 100%. Stop right there. You think control. No non-controlling interest. They buy it. What's the acquisition date? December 31, year 1. They paid $900 in cash. At the time, the carrying value of S was 600, and all the assets equal their liabilities, with the exception of equipment, with a remaining life of 5 years where the fair value is $100 higher. Information overload. Stop right there. Purchase price for our 100% stake, $900. Fair value of the non-controlling interest, $0, but I figure it anyway. Total fair value for 100% of this company, $900. What was the book value of the equity? $600. What's the excess over book value? The excess over book value, $300. Now we want to know why. Why did you pay more? What's that excess over 300? Well, some of that is attributed to what? Equipment, PP&E. Oh, I get it. The PP&E, the fair value over book value, okay, was 100. So that I understand. That's identifiable. Why did you pay, though, the other 200? I have no idea. That's unidentifiable. But what do we call that? Goodwill. Goodwill is 200. All righty. Now, the book value of this company's equity. Here is the book value of the equity on the date of acquisition. Date of acquisition, 600. Plus the fair value of assets over book value of assets, 100. So what is the fair market value, therefore, of the equity? 700. Another way to analyze this, our purchase price for that 100% stake, 900. Plus the fair value of the non-controlling interest, 0. Total fair value, 900. Less the fair value of the identifiable equity, 700. What's the goodwill that has to be inserted on the consolidated balance sheet? 200. So what is our journal entry on the date of acquisition? What is our journal entry on that date of acquisition? What are we going to do? We're going to debit investment in sub 900, credit cash. Now let's just confirm. How did we pay? 900 in cash. Cash 900. Parent cash down, consolidated cash down. Now let's do our consolidation immediately on the date of acquisition. What is our journal entry? You ready? Debit the equity, the book value of the equity on the date of acquisition. So this is on date of acquisition. Our immediate consolidation of the balance sheet on the date of acquisition. Carrying value, 600. There's your E. The A, and that consists of the common stock, additional paid-in capital, retained earnings, book value, 600. Assets, fair value over book value. The fair value over book value, that was 100. The goodwill, we just said the goodwill was 200. Liabilities, fair value over book value, 0. Investment in S, we got to eliminate, 900. Non-controlling interest, 0. Eagle in, the eagle is landed. Just make sure your debits equal your credits, and they do. We're in good shape. Now, that excess, what's the remaining useful life? Well, that equipment, fair value over book value for that PP&E, 100,000, divided by what's the remaining life? 5 years. So over time, we're going to have $20,000 of excess depreciation over time, 20,000, okay? So that will be important as we adjust our carrying value in that investment under the equity method, along with booking our equity earnings. Okay, so there it is, nice and pretty. This, by the way, is your worksheet. This is the eagle in debits and credits from that journal entry so that you can create. So again, this is done on a separate worksheet, not on the parent, not on the subsidiary, okay? Now notice something, our consolidated equity, you ready? What is the parent alone equity? Post-acquisition, what is the parent alone equity? The parent equity, 5, 6, 9,000. What's our consolidated equity? Immediately on the exam, you're thinking consolidated equity always equals the parent equity plus any non-controlling interest, 0. If the parent equity is 900, then your consolidated equity better be 900. When you add up your consolidated assets, why am I screaming? Your consolidated assets, 8,800 plus 200, 9,000. Consolidated liabilities, you got to love this company. Neither company has any money borrowed. Consolidated equity, you've got to get the same result. Whether you do it parent equity plus the non-controlling interest to get your consolidated equity, or you take your consolidated assets minus your consolidated liabilities, you've got to get the same result, or you screwed something up somewhere. Okay, so that's your check figure, folks. That's your check figure. 2 ways to arrive at consolidated equity. All righty, so to acquire the investment, what was our journal entry? Investment in sub, the parent. This is on the parent books. Non-current assets up, Current assets down, total assets no change, only a change in form. Okay, so the parent standalone balance sheet post acquisition, one asset went up, one asset went down. Okay, cash went down, investment went up, total assets no change, liabilities no change, equity no change. To consolidate, we're going to put that eagle in the car. The E, book value of the sub's equity on the date of acquisition, okay, because we're consolidating on the date of acquisition. Your A, your equipment, fair value over book value. Your G, the goodwill, 200. Liabilities, I always review the entirety, the rule in its entirety. Fair value over book value, that would be credited, that's a 0. Non-controlling interest, that's a 0. Even though it doesn't apply, I always want to review my formula, eagle in its entirety. It becomes second nature. You bang it out exam day. All right, let's try another example. See, this is the way our pre-recorded lectures work. Okay, very basic, because I don't know what you know and what you don't. We do not presume prior knowledge. Now, you might say to me, Pete, I just took consolidations, I got an A, and I remember everything. Cool. Then you could go directly to the multiple choice. We don't force you to do anything. If you want to customize this and say, Pete, I know this stuff, cool, you go right to the multiple choice. Now, look, if you're getting 85% or above, you're as proficient as you thought. But if you're getting less than like 60% correct, you got some stuff to review. You could go back to step 1 and watch the lecture. But this is it. We don't presume prior knowledge, okay? Now, in the pre-recorded lectures, we do these practice examples. So same facts as before, okay? Same facts as before. So our purchase price was 900. The book value of the equity was 600. $300 of excess. PP&E had a fair value over book value of 100. So our goodwill again was 200. So same facts as before. Now time has gone on. Okay. So time has gone on. So all this is our original facts. Now assume that goodwill is believed to be impaired on December 31, year 2. We're now at the end of the first year of ownership. We're now at the end of the first year of ownership. Goodwill's impaired, worth only $195. Income during the year, the parent company had income of $3,000. The subsidiary's income was $150. The parent accounts for the investment under the equity method. All righty, so we've got to adjust our carrying value. Okay, we've got to adjust our carrying value. So our beginning carrying value, investment in subsidiary, well, at the beginning of the year was our purchase price, 900, plus our percentage share of net income. What was the subsidiary's net income? 150. Well, let's just drop the zeros. 150 times 100%, and we own them all year. I know it seems silly, but I want to remind you, you got to watch the dates. So that is 150. That makes your carrying value go up, minus our percentage share of the excess depreciation. So folks, that fair value over book value for the PP&E, that is 100, divided by 5-year remaining useful life. That is 20,000 of excess depreciation. Remember something, folks, land doesn't get depreciated, okay? So if it's land, there's no excess depreciation. PP&E gets depreciated. So that's 20 times our percentage share, again, times 12 over 12. So that's minus 20. Minus our percentage share of dividends, 100% of nothing is nothing. So here is our ending carrying value, investment in sub, 900 plus the 50 minus the 20. We're thinking 1030. But what did we have? Impairment of goodwill. So you're about to learn something very important. You ready? These equity earnings that we would have thought the equity earnings would have been 130. No. What was the impairment? we got to subtract the equity earnings 130. We have an impairment loss. So you've got your impairment loss. And what was that? We were at 200, so that's 5. The new carrying value, 200 minus 5. The goodwill on the consolidated balance sheet has now got to be 195. So first of all, that reduces your equity earnings on the parent standalone income statement, only 125, and it affects our carrying value. We would have thought the ending carrying value 1030 less the goodwill impairment of 5, our ending carrying value on the parent standalone balance sheet, the ending carrying value, investment in S, 1025, not 1030. So folks, what you just learned from this example is when there's an impairment, it reduces the equity earnings and it also reduces the carrying value in that investment. Okay, and the goodwill is obviously no longer on the books at 200, it's now on the books at 195. Okay, so the new carrying value is 195. All right, so now we're at year end. We're now at year end. A year has gone by. You ready? Parent company, the subsidiary, their beginning retained earnings, okay, for the parent and the subsidiary. All right, so the beginning retained earnings for both companies. So our beginning retained earnings for both companies. Here we go. Going back to this would be like an exhibit in a task-based simulation. What was the beginning retained earnings for the parent? 5,000. What was the beginning retained earnings for the affiliate, the subsidiary? 400. Okay, so that's where you would get that. They would give you an exhibit like we have here. There's our beginning retained earnings for both companies. So now we're going to adjust our retained earnings. You ready? Parent 5,000, subsidiary 400. Okay, the parent had income of 3,000. So we're going to add the parent's income, the parent net income 3,000. Folks, this is their separate, okay, they acquired. This is their separate, their standalone 3,000, okay? Plus they had equity earnings of 125 minus any dividends, 0. Okay, this is their income during the year, standalone, excluding the equity earnings from the affiliate. Their ending retained earnings, 8,125. How about the subsidiary? The subsidiary had net income of 150. Okay, 150. They obviously don't have equity earnings in another company. Their dividends were 0. What's the subsidiary's ending retained earnings? The subs ending retained earnings, 550. Okay, 550. So now the subsidiary's ending equity, their common stock, no change. And you would get this information, okay, right here. All right, so what was their common stock? Their additional paid-in capital, their retained earnings. So common stock, no change, 100. Additional paid-in capital, no change, 100. But their ending retained earnings, okay, that is now 550. Okay, 550. So what's the subsidiary's ending retained subsidiary? The book value of their equity at the end of the period, 750. All righty. So now I'm going to do my elimination entry. At the end of the year, what is my journal entry? You ready? Debit the equity, the C, the A, the R. Debit the equity, 750. At the end of the period, 750. The asset, the fair value over book value, less any excess depreciation. So the fair value over book value, that was 100 minus the excess depreciation. What did we say the excess depreciation was? 20. Okay, when you adjust the carrying value, we did that. So that's 80. The goodwill is no longer at 200. 200, we had it impaired by 5. That's 195. Now add up your debits. 1025. There are your debits. Liabilities, Eagle in, fair value over book value, 0. Investment in S, the investment in the sub at the end of the period. What did we say our investment in subsidiary was at the end of the period? Not 1030, but 1025. Our investment in subsidiary, because that impairment, 1025. Lin, non-controlling interest, 0. There is none. Okay, our debits equal our credits. We did our Eagle in. There is our adjusting entry. Those would be the debits, 3 debits, 3 credits on our worksheet. 3 debits, 3 credits. That's it. And then you add across the assets of the parent plus the sub, any adjustments. Liabilities of the parent plus the sub, any adjustments. Okay. Now, to record our journal entries, the investment in the subsidiary account, ready? They had $150,000 of income. That's the sub's net income times our percentage share, 100%. So that makes the carrying value go up. There's our equity earnings. Okay, the excess depreciation, 100 divided by the 5 years, that makes our earnings go down. That makes the carrying value go down. To record the goodwill, that makes our earnings go down, makes the carrying value go down. What was our ending carrying value? 1025, 1025. Remember, folks, if the excess is attributable to land, there's no excess depreciation on land. Okay, now parent alone equity. This is the parent standalone balance sheet. The parent and subsidiary, their standalone balance sheet. What is the parent standalone balance sheet? Parent equity. 12,125. So if I took my consolidated assets, add up your consolidated assets, here are your debits and credits from the Eagle in. That's all that is. 3 debits. Put this all in one. There's your equity, 750. There's your assets. There's your goodwill. We have 3 debits and liabilities, non-controlling interest, the 0, so only 1 credit. 1 credit, we have the debits. This is all the equity being eliminated. Consolidated assets add up to what amount? 12,125. Minus your consolidated liabilities, 0. What's got to be our consolidated equity? 12,125. Another way to get it, parent equity, 12,125 plus your non-controlling interest ending balance 0. Consolidated equity, there's your check figure. Same result, different format. Same result, different format. Okay. And on your worksheet, that's where you put your debits and credits from Eagle in, and then you simply add across. Every line gets added across. Okay. So non-controlling interest. This is the N in Eagle in. Now we are going to have an example where there's a non-controlling interest. Non-controlling interest we record at fair value. And I'll show you 2 methods to back into the fair value of the non-controlling interest, all dependent upon the facts, okay? Remember, the non-controlling interest is part of consolidated equity. So that is part of your consolidated equity, folks. So when you don't own 100%, when you do not own 100%, non-controlling interest, you've got to determine it at fair value. There's one of 2 ways. Either they give you, it's traded in an active market, tell me the number of shares owned by the minority interest, or you've got to do algebra. You got to know some algebra. You got to love it. I love the algebra. My kids always went that way to make me learn algebra. Because if someday you're an accountant studying for the CPA exam, you're going to use it, baby. And here it is. Non-controlling interest is going to be on the consolidated balance sheet, part of consolidated equity, and the income allocated to the non-controlling interest is deducted when arriving at consolidated net income. Remember, consolidated net income equals the parent alone net income, parent alone net income, accounting for that subsidiary under the equity method. Okay, you'd have the equity earnings, but it's the parent alone net income, including the equity earnings. The advantage of the consolidated income statement, greater transparency. We see both companies' sales and expenses. Remember, consolidated equity is your parent equity plus the non-controlling interest. Okay, so let's do it, baby. Let's do it. Here's an example. They tell me sometimes they don't provide the fair value of the subsidiary shares. So what do? If you're taking that other course where they wreck your score, you panic. You're taking UWorld, you say, yeah, bring it on, baby. Don't give me the fair value of the shares. Let me do the algebra. So they tell me a parent company paid $500,000 for an 80% stake. Stop right there. $500,000, therefore, is worth 80% of the total fair value. Hey, I could do some algebra. Take both sides of the equation, divide it by 80%. 500,000 divided by 80%, that is $625,000. That is the total fair value of this company. Now, if we bought 80%, that means 20% is the non-controlling interest. Take that 625,000, oh, it's done for you right there. Step 2, your non-controlling interest, take that 625,000 times the 20%. There is your non-controlling interest. Okay, there it is, piece of cake. All righty. So, investment in S, initially, before any adjustments, that is $500,000. The non-controlling interest, initially, before we have any adjustments, that is $125,000. Okay, so sometimes they give you the fair value of the shares, sometimes they don't. All righty. Now, non-controlling interest, the ending balance gets adjusted just like the investment in S account. All righty. So, initial fair value, $125,000. Plus or minus our percentage share, 20% times the profit or loss, number of months over 12 though, watch those dates, minus the non-controlling interest, share of dividends, 20%. You can ignore dates. Dates don't matter, okay? Here's the ending non-controlling interest that will be part of consolidated equity, part of consolidated equity. So let's do it. Ready? Parent equity plus the non-controlling interest, there's your consolidated equity, or consolidated assets minus consolidated liabilities, consolidated equity. All right, same result, different format. In the consolidation, EAGLIN. That is an additional credit on the worksheet. We would have 3 debits, 3 credits that go on the worksheet, add across, and there's your consolidated financial statement. Okay, even though we own less than 100%, we are still adding 100% of the assets and liabilities, 100% of the revenues and expenses. Okay, even though you only own 70 or 80 or 90%. All right, non-controlling interest. You ready? On the consolidated income statement, you ready? We combine 100% of both companies' revenues, expenses, gains, and losses. And then the net income attributable to the subsidiary's net income times the percentage that belongs to the minority interest. This is subtracted when arriving at consolidated net income. Remember, consolidated net income must equal the parent net income, their stand-alone income statement, their standalone income statement, okay, the parent net income. And remember, we have one line on there called equity earnings, all right, equity earnings. Got it? All right, so let's take a look at an example. We acquired 90%, stop right there. You're thinking, hey, I got control, 1 minus 0.90, the non-controlling interest is 10%. We bought 90% stake of the stock of S in an acquisition on December 31, year 1, for a payment of $900 in cash. There's our purchase price. All righty, so I want to keep track of the facts. My purchase price, this time for a 90% stake, 900. Now I want to add the fair value of the non-controlling interest, the 10% stake. Now they tell me they had 100 shares of stock outstanding with a fair value of $8 per share. The carrying value of the stock was 600, and all of the assets and liabilities had a fair value equal to their carrying value with the exception of the equipment, PP&E. Fair value greater than book value by 100. That 100 going to be written off over 5 years. My excess depreciation is going to be 20. All righty. What is the fair value of the non-controlling interest? You ready? How are we going to figure out the fair value of the non-controlling interest? You ready? They tell us at the date of acquisition, we had 100 shares outstanding with a fair value of 8 per share. So the fair market value of the non-controlling interest, fair market value of the non-controlling interest. You ready? 100 shares times 10% that belongs to the non-controlling interest. They own 10 shares times the fair value per share, $8, $8 a share. So the fair value of the non-controlling interest, 80. Total fair value for 100% of this company, total fair value, 980. Less the book value of the equity. All right, so they had the following equity balances. This is the subsidiary. So their book value of their equity, 600. We've got excess over book value. Excess over book value, 280. I want to know why. Why did you pay more than that? Well, some of that has to do with what? Some of that has to do with the PP&E. Some of that is identifiable excess. The PP&E, that's 100. Well, what therefore is the unidentifiable excess? That's got to be 180. That's got to be my goodwill. Okay, there's your goodwill, 180. Or you could take the book value plus the fair value over book value. The fair market value of the identifiable equity, 700. Purchase price, 900 for 90%. The fair value of the non-controlling interest, that 10%, that's 80. Total fair value, 980. Less the fair market value of the identifiable equity, 700. And 980 minus 600 would be 380. My bad. On your planet, it's 380. On my planet, it's 280. So 980 minus 600 is 380 minus the 100, 280. Fair market value of identifiable equity, 700, meaning the goodwill, 280. All right, so there's your check figure. Same result, different format. Identifying why you paid that particular purchase price. Okay, so you ready? How do we do our elimination entry? To consolidate the balance sheet on date of acquisition. On date of acquisition, what do we have to do? All righty, our E, the book value of the subs equity, the C, the A, the common stock, the additional paid in capital, the retained earnings, 600. The fair value over a book value, that was 100 for the PP&E. Okay, the fair value over the book value, 100 higher. The goodwill, that is 280. The liabilities, well, the fair value equals the book value, 0. Investment in S, we bought the company. Let's see, we paid 900. Debit investment in S, 900. Credit cash, 900. How do we get rid of a debit with a credit? And then lastly, our non-controlling interest. What did we say? Our non-controlling interest was 80. If you did this correctly, your credit's 980 equal your debit's 980. And there's our initial consolidation. Okay, on the date of acquisition, that's our initial consolidation. All righty, here are my debits and credits. That's the book value of the equity, okay, the car, the common stock, the additional paid-in capital, the retained earnings. All righty, the equipment, there's the A, here's the E, here's the goodwill, there's the G. The liabilities, 0. Okay, the investment in S, your I, the non-controlling interest, the N. We have basically 3 debits, the book value of the equity, put that into 1. Okay, 3 debits, 3 credits. Now, parent standalone equity. Parent equity is how much? 9,000. Consolidated equity is what amount? Parent equity, 9,000, plus the non-controlling interest, 80, 9,080. What's my check figure? My consolidated assets. Consolidated assets, when you add across, 9,080, minus my consolidated liabilities, 0. Consolidated equity, 9,080. Same result, different formula. Okay, there's your check figure. So that's what we do with the non-controlling interest, okay? Non-controlling interest. So there's your eagle in, book value of the equity, the assets, the goodwill, the liabilities. Always review it. Even if it doesn't apply, put it in there, eagle in. There are your debits. We have 3 debits, 1, 2. Okay, we'll put that in 1, 2, 3 debits, and we have 1, 2, 0 for liabilities. There are no liabilities, but 3 debits, 3 credits. Okay, debits equal your credits. All righty. Intercompany transaction, there's 3 types. 1 of 3, intercompany sale of inventory. Intercompany sale of inventory. 2 of 3, intercompany sale of PP&E. 3 of 3, intercompany sale of bonds. All right, so those are the 3 we're going to focus in on right now. And then I want to do a task-based simulation. Okay, so let's go through these. I'm going to jump ahead. Let's do our intercompany transaction. Intercompany sale of inventory. Let's do it. You ready? When you have an intercompany sale of inventory, what are we going to do? You can do it in 1 journal entry if you want. Debit your sales. Credit your inventory for the profit you want to eliminate. And then credit cost of goods sold, that'll be a plug figure. Or we can do it in 2 journal entries if you prefer. Debit your sales, credit your cost of goods sold. Debit your cost of goods sold, credit your inventory for the profit that you want to eliminate. So we could do it in 1 journal entry, or we could do it in 2 journal entries, okay? It all depends upon if it's a task-based simulation, whether they have it set up 1 debit, 2 credits, or 2 separate journal entries. Same result, just a different format. Okay, no big deal. All right, so the effect on the financial statements that need to be eliminated. First of all, if there's any outstanding account receivable and account payable. How do we get rid of an account payable? You debit the account payable, you credit the account receivable. That's how we eliminate the intercompany receivable payable. That's the first thing, okay? Any intercompany receivable payable, debit the account payable, credit the account receivable. We've now gotten rid of, you can't owe money to yourself, okay? And then any profit in ending inventory. Take the selling price minus the cost, calculate the gross profit, okay? Tell me what percentage of that was not sold to outsiders. That is the profit we have to eliminate. And how do we eliminate profit? A credit to inventory. You got to credit inventory. Okay. So debit again, sales, credit cost of goods sold, debit your cost of goods sold, credit inventory if you're going to do it in 2 journal entries, or debit your sales, just credit your cost of goods sold, credit your inventory for the profit you want to eliminate. You could do it in 1 journal entry or 2. Same result, different format. Okay, just be mindful. If we are not consolidating the income statement, if you're not consolidating the income statement, just the balance sheet, then you'll debit retained earnings, credit inventory for the profit you want to eliminate, okay? For the profit you want to eliminate. Just debit your retained earnings, credit your inventory for the profit you want to eliminate, okay? If we're consolidating both, they give you income statement and balance sheet accounts, then obviously you could do your sales and cost of goods sold. But if there's no income statement accounts to consolidate, the only way to get rid of intercompany profit is to debit the sub's retained earnings, okay? By debiting retained earnings, you're reducing it, okay? So we got to reduce that retained earnings. All right, so let's take a look at an example. You ready? Here we go. January 1, year 1, Panther purchased inventory from an outside supplier for 8. They then turn around and sell that to Shark, one of their subs, later in the year for $12,000. Stop right there. Selling price, $12,000. So this is the parent company, okay? Parent company, selling price, $12,000. Their cost of goods sold, that cost them $8,000. So the gross profit on that sale, $4,000. Now this is intercompany from the parent to the sub. That is called downstream. All right, from the parent to the subsidiary. Okay, Shark has not yet paid Panther for the goods. So elimination entry number 1. We're going to have to get rid of account payable, $12,000. Account receivable, $12,000. One side is going to have an account receivable. The other side will have an account payable. Elimination entry number 2. I need to know how much of that inventory was sold to outsiders. Scenario number 1, we have 2 scenarios, okay? Scenario number 1, scenario 1, scenario 2. Scenario number 1, Shark does not sell any of that inventory to outsiders. So of that gross profit of $4,000, what percentage of that is still in ending inventory? 100% is still in ending inventory. That means $4,000 of profit has to be eliminated. So we could debit sales. I prefer 2 journal entries, $12,000. Credit cost of goods sold, $12,000. And then debit cost of goods sold, $4,000. Credit inventory, $4,000. All of it has to be eliminated because none of that was sold to unrelated third parties. Or you could debit your sales, $12,000. You can simply credit your inventory for $4,000 and then plug your cost of goods sold. Plug your cost of goods sold, $8,000. You could do it in 1 journal entry or 2. That would be your plug figure. Okay. Scenario number 2, they sell half of the inventory. So 1/2 of the profit has got to be eliminated. So the gross profit was 4,000. 50% of that is still in ending inventory, 2,000 has to be eliminated. So doing it in 2 journal entries, debit sales, 12,000. Credit cost of goods sold, 12,000. Debit cost of goods sold, 2,000. Credit inventory, 2,000. Or in 1 journal entry, debit sales, 12,000. Credit your inventory for 2,000, and then our plug figure, cost of goods sold, to make your journal entry balance. That's your plug figure if you do it in 1 journal entry. Okay, but immediately you're thinking, how much of that inventory is still unsold, not flipped to third parties? If 80% of it was sold to outsiders, then only 20% of the profit has to be eliminated. If 30% of that inventory was sold to unrelated parties, then 70% has to be eliminated, okay? I want to know what percent is still in ending inventory, because that's the percentage of the gross profit I have to eliminate. And if you want to eliminate that gross profit, the credit is to inventory, okay? Not so bad. So that's an intercompany sale of inventory. What if we have an intercompany sale of PP&E? Tell me the selling price minus the net book value, which is the original cost, minus the accumulated depreciation. Therein lies the gross profit, the gain, or the loss. That's got to be eliminated. That's got to be eliminated. Accumulated depreciation has got to be reinstated, as you're going to say, okay? Now, let's say we have a gain. Divide that by the remaining useful life. This is how we are going to adjust annual depreciation expense. We are going to reduce. If you want to record a gain, then you're going to reduce your depreciation expense each year. You will debit your accumulated depreciation. You'll credit your depreciation expense. We're going to allocate that gain over the remaining useful life by reducing depreciation expense, okay? The second thing we got to do is I got to get that PP&E back on the books at its original cost. That's your plug figure. We got to get that PP&E back on the books at its original cost, all right? Original cost. Okay, how do you get rid of a gain? With the debit. How do we reinstate accumulated depreciation? With the credit. You reinstate your accumulated depreciation with a credit. All right, so that's how we're going to do intercompany sale of PP&E. So there's 2 things we got to do. 1 of 2, eliminate that gain on sale. We got to reinstate that accumulated depreciation, and get the PP&E back on books at original cost, at the original cost. The second thing we got to do, the additional depreciation, take that gain, divide it by the remaining useful life. This is going to be your adjustment. You're going to debit accumulated depreciation. You're going to credit depreciation expense, okay? So little by little, we'll get that gain on the books, little by reducing depreciation expense. So let's do it. Easiest way to understand it is to do it. Here we go. Parent sells equipment. Original cost, 500. Accumulated depreciation, 200. Stop right there. Selling price minus net book value. I got cost of 500. That's the original cost minus accumulated depreciation, 200. That I'm going to have to reinstate. Net book value, 500 minus 200, that would be 300. Gain or loss, let's see. Selling price, 450. We've got a gain of 150. All righty. They tell us On the date of sale, the asset has a remaining useful life of 5 years. The first thing I'm going to do is take that gain of 150. I'm going to divide it by that remaining useful life of 5 years, 30,000. Okay, that's going to be my adjustment to depreciation. I am going to debit accumulated depreciation 30. I'm going to credit depreciation expense 30. Where does that get done? On the consolidated worksheet. Remember that list of debits and credits? We got a debit and a credit. All righty, that's step number 1. Now, step number 2. Step 2, my elimination of the gain. I got to get rid of that gain. How do you get rid of a gain? 150. Okay, 150. You debit the gain, we got to get rid of it. The parent company would have recorded a gain, we got to get rid of that gain, 150. I got to reinstate accumulated depreciation. How do you reinstate accumulated depreciation? With a credit. Because when the parent sells the asset, what's the parent journal entry? What would be the parent's journal entry when they sell this asset? They're going to debit cash, 450. They're going to get rid of the accumulated depreciation, 200. They're going to credit the PP&E at their cost, which was 500, and they're going to credit a gain of, what was it? 150. Okay, that's the parent. The sub's journal entry, they're going to debit PP&E for their purchase price, 450. They're going to credit cash, 450. Take a look at this. We've got to get that asset back on the books at what amount? We've got to get that asset back on the books at 500. It's now on the sub's books at 450. So folks, your plug figure is going to be to the PP&E. We want to get that PP&E back on the books at the parent or sub, whoever sold it, at the original cost, 50. Or you could actually see it directly, difference between the new cost versus the old cost, okay, plus 50, or you plug it, okay? So that's an intercompany sale of PP&E. Cool. How about an intercompany sale of bonds? Treat as if bonds were retired. You're going to treat it as if the bonds were retired. Okay? So what we want to do is to eliminate the intercompany sale of bonds. We're going to debit the bonds payable. That's how you get rid of a liability, right? Debit the bonds payable. Credit the other company's investment in bonds. Okay, then you're going to plug a gain or loss on retirement, to balance your journal entry. Okay, if you repurchase the bond, if you're repurchasing the bond, if the repo price for the bond, repo price of the bond is greater than the carrying value of the bond, that is a loss. If the repo price for the bond is less than the carrying value of the bond, that is a gain. Okay, so we're going to treat it as if that bond was retired. Okay, one company's investment is the other company's bonds payable. So take a look at this. You ready? South Dakota issued 8% bonds to external parties at $1,000 face value several years ago. Stop right there. What was the original entry? The original entry when the bond was sold, they debited cash, 1,000. They credited bond payable, 1,000. We've got to get rid of that bond payable. We got to get rid of that. Okay. They tell us South Dakota, the acquirer, purchased all of the outstanding bonds on the open market for $900 plus accrued interest. So they had to pay the accrued interest. So when there's accrued interest on the bond, the buyer of the bond has to reimburse the seller for that accrued interest, okay? So for the buyer of the bonds, they've got investment in bonds. What did they pay? 900. Okay, 900. So the accrued interest, $1,000 bond times 8%. Now, how often are we paying interest? Annually. So the accrued interest is 80. All righty, that's 80. So they're going to credit cash for 980. Okay, and they've got this accrued interest receivable, 80. So that's the buyer of the bond. Okay, that's their journal entry when they buy the bond. All right, now these two companies, South Dakota, let's see, they issued the bonds. Pennsylvania company, they're owned by South Dakota. They acquired South Dakota. These two companies have to be consolidated. So how do we get rid of the bond payable and the investment in bonds? You ready? To get rid of a liability, we're going to debit the bond payable, 1,000. To get rid of the asset, we're going to credit the investment in the bond, 900. And here's your plug. It's as if they bought back their own bonds at 900. There's your plug figure. Gain on retirement, 100, piece of cake. And this might complicate it a little bit, but the accrued interest receivable, you can't owe interest to yourself. So when there's accrued interest, we get rid of one side has going to have interest payable. The issuer of the bond, the borrower, the issuer of the bond, they're accruing for interest. They debit interest expense. They credit interest payable. That would be 80. Okay, how do you get rid of a receivable and a payable? Well, to get rid of a liability, you debit it. To get rid of the asset, you credit it. That's the accrued interest. Okay, so let's now do a practice scenario. Oh my goodness, I feel like I'm getting, Megan, are you all right? Is everybody all right? How we doing out there?
I mean, I'm living the dream here, Pete. I'm learning so much about consolidated financial statements. Like, it is making my Saturday, Pete. Every Saturday I get to spend with you is a good Saturday.
All right, now here's the deal. I got 2 sample TBSs. One I'm definitely going to do. The other one is if you want to stay, you stay. All right, I want to do 2. I want to do 2 because I like 2. So, you know, I know it's almost 1 o'clock. This one won't take too long. I want to do both. I want to make sure you guys are getting your time's worth. All right, so here's 1 out of 2, how this could be tested in a task-based simulation. All right, this is now the other part of the UWorld course. What I just went through now is what's on pre-recorded videos. We set up the rule, we do examples, then you would do your multiple choice, and then you would come to the live online session. This is kind of part 2 of our course. Well, hey, how do you then apply this to task-based simulation and or multiple choice? So let's see what that would look like. So our goal here, one type of task-based simulation is you've got to find somebody screwed things up. They've already done the consolidation, but they've done it wrong. What the hell did they do wrong? How do you fix? I hate that. Just tell me, just let me do it right. But look, all you got to do is, if they tell you to correct somebody else's nonsense, first thing you do is what should have been done. Then you look at what they did, and then how do you get it from what they did to what should have been done? Watch how we do this. Okay. So the first thing I do is on the exam, before I read the facts, what the hell do they want me to do with these facts? Okay, so here are my facts. Here's a worksheet. We've got to adjust the consolidation worksheet. So it looks like they might have screwed up these accounts right here. So if I'm taking the exam, I'm immediately thinking my eagle in. What did they do? And then I'm going to compare that to how I'm going to do it the correct way, okay? They give me some information. Now, here's what they did. All right, here is what they did. Is this correct? This is their eagle in, EAGLIN. I don't know nothing about the numbers, but there's their eagle in. All righty, their debits and credits. I don't know if they did it right yet. We'll do it. Exhibit 2, bought 85% of this company. They had 100,000 shares outstanding. Stop price at $3.50 a share. All right, as soon as I see that, I'm thinking, I have control, and the non-controlling interest is 15%. Okay, the non-controlling interest is 15%. So we bought 85%. Now, how much did we pay for that 85%? $325,000. Agreed? So my purchase price for 85%, $325,000. Now I need the fair value of the non-controlling interest, the other 15%. Well, they tell me they had 100,000 shares outstanding, okay? We didn't buy 15%. So 100,000 shares times the 15% we did not buy, that's 15,000 shares. And what's the fair market value per share? $3.50. 15,000 times $3.50. Fair value of the non-controlling interest, I got that to be $52,500. $52,500. Add that in, $52,500. So the total fair value for 100% of this company is therefore $377,500. Okay, now I want to subtract the book value of the sub's equity on the date of acquisition. So I go back, I saw this. Okay, here's my pre-consolidation financial statements. Okay, my pre-consolidation financial statements. All right, so December 30, let me just double check. What was the date of acquisition again? December 31st. Okay, so that's my pre-acquisition, December 31st. Okay, let's see, any other facts? Okay, here's Sunflower, December 31st. Okay, this is all their book value. So here's the book value of their assets. Here's the book value of their liabilities. So here's the book value of their equity. 460 minus 260, 200,000. Okay, so let me subtract the book value of the equity. Book value of the equity, 200,000 on the date of acquisition. So the excess over book value, excess over book value. Well, that works out to be how much? 177,500. Agreed? 177,500. Now, are there any assets? Let's see. Any assets where the fair value is different than the book value? All right, so let's see. Got those facts, those facts, those facts, those facts. Let's see. Exhibit 4. I received updates regarding the December 31st acquisition. On the date of acquisition, the fair value of the machinery was determined to be $150,000. All other assets, fair value equals book value. Okay, so now let me go back to that financial statement. The machinery, here's the book value of the machine. The book value of the PP&E, $80,000. They just told me in Exhibit 4, the fair market value was $150,000. So the excess fair value over book value, $70,000. That's the excess of fair value over book value. So the excess, the identifiable excess, is how much? $70,000. That means the unidentifiable excess, the goodwill, has got to be what amount? $107,500. Agreed? $107,500. Okay, let's see what else we got. Additionally, on the date of acquisition, Poppy sold inventory to Sunflower. Stop right there. We have an intercompany sale of inventory. So I'm thinking selling price minus cost of goods sold, gross profit. We sold for $14,000 at a profit of 40%. So selling price, $14,000. My gross profit is 40. That means my cost has got to be 60%. Agreed? So cost of goods sold, 60% of 14,000. 60% of 14,000. That is $8,400. Gross profit, therefore, 40% of 14,000, or simply 14,000 minus 8,400, $5,600. Now, how much of that was sold to outsiders? They have not sold any to outsiders. So 100% of that gross profit has got to be eliminated. All $5,600, because none of it was sold to outsiders. I'm going to debit my sales, $14,000. Credit cost of goods sold, $14,000. I'm going to debit cost of goods sold, $5,600. Credit inventory, $5,600. Or you could do it all in one journal entry. Debit sales, $14,000. Credit your inventory, $5,600, and then plug your cost of goods sold to make your journal entry balance. Plug your cost of goods sold, $8,400. Okay, now I'm also going to remember, let me see, did they give me anything here? Do I have any income statement accounts? In my consolidation, let's see, I got all assets, liability, I got no income statement accounts. So folks, when you do this, since there are no income statement accounts, how do we get rid of this $5,600 of profit? If there's no sales or cost of goods sold, then the only way to get rid of that profit is to debit retained earnings, $5,600, credit inventory, $5,600. There's no income statement accounts, so that's the only way to do it. Okay, so please ensure that, all right, so let's see. I think we got everything. So Exhibit 4 I dealt with, there's Exhibit 3, there's Exhibit 2, all right, there's Exhibit 1. This is what they did. Let me tell you what they should have done. You ready? Now we're gonna go through what they should have done. All right, so we want to eliminate the book value of the subsidiary. All right, so the book value, let's go back to that. Where was the book value of the subsidiary? The 140 and the 60, the book value. So remember, we're doing this on the date of acquisition, So this is a consolidation immediately. That's why there's no sales and cost of goods sold. There's been no activity yet. So on the date of acquisition, you ready? Book value of the sub's equity. So let's see, that was the 140 and the 60. 140 plus the 60, 200,000. Let me just move that over a little bit. 140 and the 60, we got to eliminate both of those, 200,000. Fair value over book value for the PP&E. What did we say the fair value of the book value was? The excess, the identifiable excess, 70,000. Here it is, identifiable excess. So I'm going to debit my asset, $70,000. Fair value over book value, 70,000. Put my zeros in there. Goodwill. We said the goodwill has to be what amount? 107,500. 107,500. Liabilities, fair value equal to book value, 0. Investment in sub. What did we pay for this company again? Purchase price, $325,000. Non-controlling interest. What did we say the non-controlling interest was? Fair value of the non-controlling interest, $52,500. Okay, so let me just make sure my debits equal my credits. So my credits are $377,500. My debits are $377,500. So it looks like we're in good shape, and that's a 200. Sorry, folks, 200 plus 70 plus 107,500. Now, I'm not going to be all over the place. Okay, I'm going to do it step by step. The only thing you got to remember, folks, remember we had this other, sorry about that. We had that other elimination entry. Okay, so we got to do eagle in, and any other intercompany transaction. So I just want to make sure I get that here as well. So I got to debit my retained earnings. Oh, God, I can't remember. My intercompany sale was how much? $5,600. Okay, so that happened because I'm thinking to myself, how did that? Oh, that was right there on the date of acquisition. They quickly had that sale. I get it. All right, debit retained earnings, $5,600. Credit inventory, $5,600. All right, let me deal with these one at a time. Okay, we've got to eliminate the book value of the equity. Did they do that? Well, let's see. The paid-in capital, 140, they got it. Okay, now retained earnings has to be reduced by 60 and this $5,600. Okay, so actually, to reduce retained earnings, we got to reduce it with a debit. Okay, so to reduce retained earnings, number one, we got to debit the subs retained earnings, 60,000, and number two, we got to debit retained earnings for 5,600 to eliminate the intercompany profit. So actually, the debit here should not be for 60,000. That should be 65,600. So that takes care of that. We got the 60. Now inventory. Did they credit inventory? They never credited inventory for 5,600. They should have credited inventory for 5,600. Goodwill. Where the hell is the goodwill? It is not 55,000. Where the hell they get that from? The goodwill should be 107,500. That should be debited, 107,500. No liabilities. Investment in sub. They did that correct, 325,000 on the credit side. And then where the hell is the non-controlling interest? That should be part of consolidated equity. Where is the non-controlling interest? They did not put the non-controlling interest in there. So the non-controlling interest has got to be credited for $52,500. So those are the corrections we have to make. All righty. So we look at what should have been done versus what was actually done, and we make our adjustments accordingly. All right. So now let's go to the worksheet. Inventory. You ready? Was that done correctly? No, they should have credited inventory for $5,600. They did not do that. All righty. So is inventory correct? No. What is the amount? It should be a $5,600 credit. Eliminate intercompany profit. That journal entry, debit retained earnings, credit inventory, $5,600. Okay. How about the machinery? Did they do that correct? Let's see. The machinery, they added the 70,000. They did that correct. So that's okay. Okay. They added the extra 50,000 over book value. Non-controlling interest. They never put it in there. Non-controlling interest. No. That's got to be part of consolidated equity. So 52,500, that's a credit. That's going to be part of consolidated equity. Goodwill, what did they have in there? 50. No, they screwed it up. That should be, what is the amount that should be there? 107,500. You got to insert goodwill on the consolidated balance sheet, but obviously at the right amount. Common stock, I think they did that correct. Yeah, they eliminated the subs common stock. They did that correct. They eliminated that with the debit. Retained earnings, no. While they debited retained earnings for the sub 60, they forgot to reduce retained earnings for the intercompany profit, and you reduce retained earnings with a debit. So, no. They have to increase it by $5,600. So $5,600 for a total of $65,600. That's what should be there. So we got to debit retained earnings. So part of it was done, 60,000 to eliminate subs retained earnings, and then 5,600 to eliminate intercompany profit. And we could not do that with the sales and cost of goods sold because those weren't provided on the worksheet. So that should be 65,600. We have to increase it. The adjustment should be a debit to 5,600 to reduce retained earnings by that intercompany profit. All righty. So that's one example of how this could be tested in a task-based simulation. I don't know, maybe I should stop it here. You know, I got yelled at earlier. I mean, like, I don't know, people chime in. I can't see you. I got to see you guys. All right,
We're
in the
here,
chat box.
They want to see them. They want more, Pete. They want more.
I want to see thumbs up. I want to see go Pete, go Pete, go Pete, go Pete, go. When I say CP, you say
A.
There you go. All right, come on, folks. Put it in the chat box. You want more?
It takes a
Let's
second
go.
for it to trickle in, but I think you're gonna get yeses, Pete. Keep going.
You want more? All right, let's do another one. All right, here we go. Can you see my screen again?
I can still see it, Pete.
All right, you can see my big head. Got to get rid of my big head. All right, here we go. Let's do another task-based simulation.
Getting some let's go.
Let's go.
Let's
I'm gonna get 1, 3. Paulie, let's go. All right,
sir.
Paulie, I'm going to turn it over to you in a second. You ready?
I'm also told we have no lives but CPA. Keep going. They got
That's
no
right.
hot
What
dates
else
they're
is there to
missing.
do? What else is there to do? As Paul says, you got to devote all your time to studying, okay? That means you got to cut out working out. You're going to put on a little bit of weight. You're probably not going to shower. You're not going to smell so good, but do you want to be a CPA or do you want to smell good? You got to keep your priorities straight. All right, here we go. Another task-based simulation. Ready, Paulie? Here we go.
Ready. Here we go.
Here are the facts. I don't know what to do with all those facts. Oh, I got to adjust these numbers. All right, here's some unconsolidated before consolidation. So the sub, what's going to be the book value of their equity? 141, so 190,000. There's the book value of the sub's equity. Cool, cool. All right, what else we got? Oh, then there's the answer. We don't want the answer. All right, so here we go. Ready to tell me? Right, and I got to add a slide in here. Otherwise, I ain't gonna have no room. So here we go, one at a time. 1, 2, 3, 4, 5, and 6. Let me insert a slide, a new slide. Can I do it? Insert. Is it gonna let me insert, Paulie? There we go. No, I don't want that one. Sugar. Let's get rid of that one. Delete. I want to insert. Oh, I don't want file. Insert a nice clean slide. New slide. Come on, man. Look at that, yo. Do I have a blank slide in here? No, come on. I need a blank slide. I want to write neat. Otherwise, you people are going to get pissed and stab me. Come on. Let's try this one more time.
Go back to insert. The down arrow. There you go. Right there. Yeah.
New slide. Yeah, I'm hitting it. Oh, there it goes. I'm not being patient. There we go. Sweet. Blank. There we go. Like my brain. All right, one at a time. You ready? I'm buying 90%. Stop right there. I got control. What's my non-controlling interest? 10%. They got 100,000 shares of common stock outstanding. My purchase price is $155. On the date, the fair value of the non-controlling interest is $1.70 a share. Stop right there. 100,000 shares times the 10% we didn't buy. That's 10,000 shares times $1.70 a share. There's my non-controlling interest. Okay, my non-controlling interest, 17,000. All righty. Let's see. Shaw's equity equaled 150,000, and the fair value of their identifiable assets equaled their liabilities. Okay, so that's it. Doesn't look like there's any excess. So here we go. Number one, my purchase price for that 90% stake was how much again? $155,000. Agreed? The non-controlling interest, the fair value, the other 10%, that should be 155,000. Sorry about that. 17,000 total fair value for 100% stake in this company would therefore be $172,000. Now, what was the book value of the equity on the date of acquisition? I think they just told us that. Shareholders' equity, 150. Fair value, assets equal their carrying amounts. Okay, cool. So fair value equals book value. So that's $150,000. So therefore, the excess over book value is $22,000. How much of that is identifiable excess? Well, since the fair value equals the book value, that's a 0. That means all of it is unidentifiable excess, also known as what? Goodwill, $22,000. We got one piece of the puzzle, and we debit our investment in S, $155,000 cash, credit cash, $155,000. One piece down, 5 to go. All righty. Step 2. Oops. Number 2, we sold equipment. Original cost 30, carrying value of 15 for $36,000. Stop right there. Number 2, we got a sale of PP&E. Sale of PP&E. The selling price was how much? Short-term memory, Paulie, not so good. We sold it to Shaw for $36,000. My selling price, just move that down a little bit. My selling price of the PP&E, $36,000. Cost minus accumulated depreciation. What was the net book value? Let's see. They told me original cost 30, carrying value of 15. So 15. So that means we got what? A gain on sale. Gain on sale of $21,000. Okay, the cost was how much? The carrying value was 15. The cost, I think they said, damn my brain. Original cost 30. Original cost 30. So what must have been the accumulated depreciation then? It had to be what amount? 15, because if your carrying value is 15, then your accumulated depreciation must have been 15. What's the remaining useful life on this thing? The equipment has a remaining life of 3 years. All righty. So what's going to be my journal entries here? Okay, I want to get rid of that gain. So my elimination entries. I'm going to debit the gain, 21,000. Want to get rid of that. I got to reinstate the accumulated depreciation, 15,000. And check this out. This is weird. The original cost was only 30. They ripped off their sub. They sold it to them for 36. So folks, we actually have to reduce the PP&E by 6,000 to get it back to its original cost of 30. So they ripped off. That's like selling to your little brother or little sister. You buy it for 30, you sell it to them for 36. I love it. All right, what are we going to do with this gain now? We're going to write it off over its remaining 3 years by reducing depreciation expense. So $7,000. I'm going to debit accumulated depreciation, 7,000. I'm going to credit depreciation expense, 7,000. All righty. So that takes care of bullet point number 2. Bullet point number 3, what we got? Bullet point 3, where you at? Let's go. Let's see, bullet point 3. On June 30, year 2, Post sold merchandise to Shaw for 60, which included a profit of 20. So let's see, selling price 60. Cost of goods sold, therefore, must have been what? 40. So that's a gross profit of 20,000. All righty. On December 31st, half of that was still in Shaw's inventory. So how much of that has to be eliminated? 1/2, 50%, $10,000. Intercompany profit has to be eliminated. So number 3, intercompany sale of inventory. So I'm going to debit sales, credit cost of goods sold. Let's see, what was that selling price again? 60,000. Debit sales, credit cost of goods sold, 60,000. And then I'm going to debit cost of goods sold, credit inventory for the profit we have to eliminate. How much profit did they say we have to eliminate? Half of 20, that was 10,000. Or I could do this all in one journal entry. Debit sales, 60,000. Credit cost of goods sold, that's your plug figure. Inventory, 10. So your cost of goods sold, 50,000. Well, if you reduce it by 60, then increase it by 10, your net reduction is 50. That makes sense. If there's no income statement accounts, then what would we have to do? Just as a reminder, debit retained earnings, 10,000. Credit inventory, 10,000, just in case there's no cost of goods sold and sales, if there's no intercompany income statement accounts. Number 4, Shaw paid cash dividends of 30,000. The carrying value of the sub's going to go down by, what did we buy? 90%. Carrying value of the sub is going to go down by 90% of 30. The non-controlling interest is going to go down by 10% of 33. All righty, so that we're going to adjust the carrying value. Okay, what else do they tell us? Number 5, we paid $91,000 to purchase 50% of the outstanding bonds issued by Shaw. The bonds mature on December 31st, year 6, and were originally issued at par. So the original issuance, they debited cash. That must have been 100,000. Excuse me, yeah, 100,000. Credit bond payable, 100,000. This company just bought. What happened, Paulie?
Hey, I'm here.
I hear you. We can hear you. You all
I'm
right?
good. I'm good. I'm good.
Debit investment in bonds, 91,000. Credit cash, 91,000. So for number 5, how do we get rid of that intercompany bond? The intercompany bond. We're going to get rid of the bonds payable at par, $100,000. This company just bought, they got investment in bonds, 91,000. What's your credit to? As if you bought it back. You just got rid of $100,000 in debt by paying $91,000. So folks, we got a gain, that's your plug figure, gain on retirement, $9,000. Okay, that takes care of number 5. And number 6, let's see, we recorded its equity in Shaw. All right, did Shaw have any profit during the year? Let's see, I see they got dividends. Let's see, what was their profit? So let me just go through additional facts. Let's see, additional facts. Let's see, okay, prepare your journal entries. All right, let's see, did they have earnings? All right, so let's go through these one at a time. Well, that's a different TBS. That's a different one. This is the one we're doing. All right. Let's see. So they want consolidated cash. Okay, they want consolidated cash. So they want these numbers. They want the consolidated amounts. All right, folks, they want the consolidated amounts. So here we go. Let's take a look at their individual financials. The cash, 50 plus 15. $65,000. Okay, so that's their balance sheet at the end of the year, 65,000. So, and this is December 31, year 2. Let's just make sure we're looking at the right things here. What date? January 2nd, year 2 is the date of acquisition. Okay, so January 2nd, year 2 is the date of acquisition. All right, but the consolidated cash, just simply add the 15 plus 50 plus the 15, that's 65,000. Okay, the goodwill, there was no impairments. So what should be the goodwill at year end? If there's no impairments, the goodwill should be what amount? $22,000. Okay, $22,000, that should be our goodwill. There were no impairments, so if there's no impairments, 22,000. Okay, the equipment. So let's see. The only thing we had to the equipment we have to credit the PP&E for 6,000. On the consolidation worksheet, we've got to credit the book value equal to fair value, so we don't have to worry about that. So we've just got a reduction of 6,000. So the PP&E, that is going to be 440 plus 360 minus $6,000. So let's see, 440 plus 360 minus 6,000. Let's see, 794,000. So that is our consolidated PP&E. 709. The key to getting this right, PP&E has to go down by $6,000 because we had an intercompany sale where we ripped off our little brother. What we bought for 30, we sold to them for 36. We got to get it back down to its original cost. Okay, common stock on the consolidated, the only thing we should see is the parent only. What is the parent common stock? 100,000. So on the consolidated balance sheet, parent only, 100,000. Parent only. On the consolidated balance sheet, what should the investment in Shaw be? 0. That is eliminated, and I'm going to do the elimination entry with you. That's going to be eliminated. Even though I don't ask for it, we're going to review it. Dividends, parent only. Parent only, because the subsidiary's dividends are reducing the investment in the subsidiary as well as the non-controlling interest. Okay, so it's going to be the parent only. The parent only dividends, 80,000. You can't pay dividends to yourself. So that's parent only. You cannot pay dividends to yourself. All righty. Bonds payable. Let's see. We did something with bonds payable, didn't we? We got rid of bonds payable. The intercompany bonds, we got rid of bonds payable. We retired $100,000. So on the consolidated balance sheet, let's see, we've got the bonds payable of parent 0, sub 200,000, sub 200,000. So 0 plus 200,000 minus the 100,000 that we retired. So that means on the consolidated balance sheet, that should be only $100,000. Only $100,000. We retired $100,000 of debt. And then the non-controlling interest, the ending balance, folks. Watch this. You ready? Let's do it here. Beginning balance, non-controlling interest. What was our beginning balance again? Going way back here when we bought them. Beginning balance, $17,000. Okay, that was our beginning balance, non-controlling interest, $17,000. Plus their 10% share of the subs net income. What's the subs net income? 70,000. 70,000, not 70%. 70,000 times 10%, we're going to add 7,000. Minus their percentage share of any dividends. That was the net income. What were the dividends? 30,000. So dividends 30. So that's a minus 3,000. So the ending carrying value for the investment, ending carrying value in the non-controlling interest, 24 minus 3, $21,000. Okay, so the ending carrying value, that is part of consolidated equity. That 21,000 would be part of consolidated equity. Okay, so we answered this question, but screw this question. We love this stuff. We have no lives. Let's do the eagle in. Okay, let's do the eagle in. You ready? Beginning carrying value, investment in S. What was that beginning carrying value? $155,000. $155,000 plus their 90% share of the net income. And remember, this was an entire year. January 2nd, year 2 is the date of acquisition. December 31st, year 2 is the date of consolidation. So all 12 months. So 90% times the 70,000, all 12 months. What is that? Plus 63,000. minus 90% of the excess depreciation. 0, there was none. Why not? Why was there none? Because the fair value equaled the book value. Minus our 90% stake in the dividends. What were the dividends? 30,000. So that's the net income. That's the dividend, minus 27,000. So what is the ending carrying value? Investment in S. 155 plus 63. Let's see, 155 plus the 63 minus the 27, $191,000. Okay, so that is our ending carrying value. I'm just curious. There it is. Look at that, folks. We got the same number they got. 191,000. This is the end of the year. End of the year. Okay, so now let's do our Eagle in journal entry. See if we can do it. Okay, our Eagle in journal entry. All right, let me see. Where can I do it? I'm going to do it here. You ready? I'm going to debit the sub's equity, the equity of the sub, the book value at the end of the year, equity of the sub, the book value at the end of the year. So that would be the common stock, additional paid in capital, and retained earnings. Let's add it all up. 140, 40, 180, 190,000. So we got to debit the equity of the sub, the ending balance, 190,000. The A, fair value over book value, 0. The G, the goodwill. The goodwill was what amount did we say? 22,000. Liabilities, well, the fair value over the book value, 0. The investment in S at the end of the period, at the end of the year, that was 191,000. And then the end, the non-controlling interest, the ending balance, what was that? 21,000. So 190 plus the 22, 212. 0 plus 191 plus 21, 212. Whoop, there it is. Yeah. And what's the consolidated equity, by the way? What's the consolidated equity? The parent equity at year end plus the non-controlling interest ending balance. What was the non-controlling interest ending balance? 21,000. And what was the parent equity? The parent equity end of the year, the 100 plus the 250 plus the 404. So the 100 plus the 250 plus the 404, 100 plus 250 plus 404, $654,000. So the parent equity end of the year, 654,000. So consolidated equity, if they ask for it, would be the parent equity standalone plus the non-controlling interest. So 654 plus 21, consolidated equity 675. And if we had the consolidated assets, we don't have all of them. We do not have all the consolidated liabilities, but we would get the exact same answer, 675. Okay, we don't have, this is only an excerpt. It's not the whole thing. Okay, it's just part of selected accounts, selected. We don't have all the assets and liabilities. Woo, baby, let's do it. Paulie, how'd you like that? How'd you like that? Do you wish, Paulie, that you could drop out of sales and be a big-time CPA now? Is that what you're wishing, brother?
I love it. It was awesome.
All right, now I need to put up slides for you or no, Paulie? Guys, everybody, I need you to do me a favor, if you don't mind. We really, look, UWorld is a brand new course now between the homegrown talent, Megan, Amber, and others. The Wiley folks they brought over, unbelievable. Suzanne, Greg Carnes, people who wrote the book on tax. Roger Phillip, who's amazing, the best I've ever seen, funny, energetic, knows his stuff inside and out, been around for like 200 years. He's a little old. And then they brought me too. They consolidated really talent from 4 courses. UWorld is the course we want to be at your university, and we want to be at your firm. Now, if your firm reimburses for record because they got an old contract or because they're discounting their price to no end, but you want to take us because you don't want to pay, we got delayed payment. You just tell your firm, hey, reimburse me. We will sell you the course. You don't have to pay. When your firm reimburses you, then you could pay us, okay? But please, if you can, spread the word. I know social media today, everything is word of mouth, but not the old fashioned way. It's online. Please, man, we hope to, this is why we do this stuff. We want you to see it, test drive it. We want to earn your business. Paulie, it's all yours. Take it away.
Can you go to the next slide there, Peter?
Yeah, yep. Now, I got to see if I got the right slide deck here, Paulie. Let's see. Yes.
Yeah, that's good. That's good. Right there. Yeah. Yeah, so just so you guys know, Peter's on the East Coast, I'm on the West Coast, and we got you all covered in between. I want to let you know, if you have not heard of UWorld, you might have heard of Roger CPA. We purchased Roger CPA. He's number 2 right here. We got PO, who came from the other company. And we also recently purchased Wiley Efficient Learning, and we got all these other amazing instructors who are specialists, PhDs, right? All have public accounting experience. So you will see, besides just PO and Roger Phillip, who are our lead instructors, you'll see all these other instructors all throughout. I love this screenshot because I think this looks a lot like how your accounting firm looks. We got men, women, different ethnicities, etc. Next slide, if you can, PO, please.
And by the way,
go ahead.
Megan Burke was with us today. So Megan, thank you so much for your assistance and answering questions in the background. Megan, homegrown talent, awesome.
You know, Pete, I'm here anytime, right? Like, I love to be here and answer questions for you.
No, Megan's the best, man. Really, just does in-house stuff, Big Four, all the time, PhD, but as nice as they come, folks. You really couldn't meet a nicer person. In addition to her intelligence, she's just as nice as they come. Paulie, I'm sorry, go ahead.
No problem. Hey, as you guys know, the new 2024 exam evolution is significantly different. CPA is the division that creates the CPA exam, and in there they have these blueprints, right? So they have different topics, groups. They're going to have different skill sets, what they have to do: remembering, understanding, application, analysis. Well, what we've done, you go to the next slide, is we actually have made this easy for you. So, and by the way, we're the only vendor who's done this. We did a 100% rebuild, right? Because we had Roger CPA, we got Wiley, we got PO who came over. We did a 100% rebuild for the 2024. We did all new ebook, all new video lectures, and we took the blueprint. Anywhere you see this blue little check mark, this is the blueprint from CPA. Whether it be an analysis or an application or things to remember, we put it right in there in the book, and then we address it in the text and also in our video lecture.
And guys, the reason why that's so important, this lets us know whether that particular topic is likely to be multiple choice questions and or a task-based simulation. So like things like remembering and understanding lend themselves well to multiple choice, whereas the higher level analysis, evaluation, application could be multiple choice, but that lends itself well to a task-based simulation. So that's how we set up our notes today, based upon, hey, how are they likely to test this, right? So we gave you those examples so that no matter how they put it to your exam day, you'll be good to go. Sorry, Paulie.
No, that's good. That's great. Next one. Next slide. All right, this is one of the biggest differences that I would say why we have such a high pass rate. So on the left is a sample of one of our multiple choice questions. The first thing we do is actually, we just don't say right or wrong. We do say that on the left-hand side with the big green or red marks. But on the right, see immediate performance feedback. These percentages are based off people who've studied with us and passed. So you can see in this specific one here, you marked number C, which was wrong. Only 17% of the people answered that. The correct answer was A, where 74% of the people answered that. I say anything over 70% is an easier question. That helps you. But you'll see some of the ones that are correct, only maybe 40% got it right. So that gives you a good perspective, like it's a really hard question or it's tricky. Hey, and even if you missed, so did nearly 60% of the people across the nation, okay? But besides just that, what we do on the right-hand side is our answer explanations is very detailed and thorough, okay? We just don't say, hey, A's right because B, C, and D are wrong. What we do, we try to start off with a visual image wherever possible on the top, an easy to understand explanation below it, and then we say why B was wrong, why C was wrong, why D was wrong, and then also we wrap up with the nice things to remember. And even below, we still reference again the blueprint, whether it's a representative task, the skill level, etc., and we'll even link you back on the bottom to the ebook. Go ahead, next slide. All right, a couple last things, and I'm going to show you how you can order with us. On the left, we have something called a Smart Path technology. Okay, this is amazing data. As you guys are in CPA and you're about data, we've taken data with folks who studied with us and passed the CPA exam and collected the average and said, what percentage correct did they get and how many questions did they go through, and we set up these targets for you. Okay, We know if you can hit those targets, you will be successful. And so we have that built into our program. And then on the next slide, we have something else too. Unless you want to say something here, Pio. Go ahead.
No, I just want to tell them, guys, unlike other courses where they say, hey, you got to work every single question in the software 55 times. Yeah, if I quit my job, shoot my dog, I could do all that, drop my goldfish, then I got all the time. Look, it's a combination of the percent correct and the volume of questions worked. We don't want you to unnecessarily work 157 questions because we happen to have 157 questions in our software. Once you hit a certain target of volume and percent correct, you know confidently, hey, I'm good to go. I can move on to my next subtopic. So we don't just blindly tell you, you got to do all this stuff. Why? If you're proficient in that area, it's time to move on. Once you turn these things green, you're good to go. Go ahead, Paulie.
Yep. And this is the last piece, and I'm going to show you how to order. So we have a dynamic study planner. There's 3 different variables in here. One is when you want to start studying, when you want to be finished with the course. Second one is you want to use our full course or a fast, quick course on the left, just the questions only. And then what we do is on the bottom tell you how many hours is it going to take to get through the course with the dates you set up on top. So we do trainings on this where you can actually really, like I say, this is a dose of reality. If you can't put in 20 hours a week, then you need to extend the time out. But if you can put in 20, 25, then down on the bottom, you could drag these blue little bars on the bottom there. It will show you how many hours per day you're willing to work so to meet that 19 hours. So like right now, this one's set up with nothing on Saturday and Sunday and everything on Monday through Friday. But you might want to flip that if you're working full time at a firm, right? You might want to go heavy on the weekends on Saturday and Sunday. Put in 4-hour blocks and only go 2 hours, 2 hours, 2 hours on the weekdays. You can set it up, customize for your own ability. You click adjust the plan, and it's going to give you day by day everything you need to get done. It's going to be a pacing guide, a planner. You can look at it from daily, weekly, or monthly.
Yeah, guys, very important too. A lot of the firms we're working with, we are advising the L&D people, the HR, the manager, your supervisor. You should share your study plan with them. So they might tell you, hey, I see what you're doing this week, but hey, we're going to have you busier or less busy. So then you could adjust your study plan, but you want to share this with your supervisor, with your manager, so they can see not only month by month, but what your goal is in general to get the CPA exam out of the way. That's part of when you go through the review process. They want to see you're on your way to being a CPA, right? They want you to get certified, not because they like you or anything, but your billing rate goes up as soon as you're certified. No,
they may like you too. They may like you too. I don't know. All right. You're going to fall into one of 3 categories, in my opinion. You're either going to be a student right now, you could be at a firm right now, or you could actually already be an existing customer. Whatever the case is, if you're an existing customer, we thank you. If you're a student or you're at a firm and not using us, you can order right here with this QR code direct. But we would say this is called our Elite Unlimited package. It's everything you're going to get. Okay, you're going to get we call print-based study guides, which are like textbooks shipped to you. You're going to get online ebooks. You're going to get 8,000 quality questions, video lectures, SmartPath, the dynamic study planner I showed you, live boot camps, more of Peter, more of other folks where we go live. Okay, what this basically means is it won't expire on you. You're going to have as long as you need to pass all 4 sections of the CPA exam. So this is one way you can order if you just want to pay on your own. But we highly recommend that you reach out to us because if you're at a firm and maybe the firm already said, hey, we only are going to offer another vendor, but you want to use us, we might be able to get it to you for free on that second one with an ambassador. Go ahead, the second one, Pio, where you were with an ambassador program.
If you're looking to put together a deal at your university or your firm, email Paul, not P. Olinto, I'm putting my name, P. Lewis at UWorld. So if you want to put together a deal at your firm or your university, email Paul, he'll make that happen, okay? And because you took the time to make that happen, you're going to qualify as a UWorld ambassador. Look at this.
Yes, yeah, so we have ambassadors for universities and for firms. So we can actually get you the program for free if you're going to become an ambassador. So just don't think, hey, I'm stuck with the program even though I'm not doing well. We can help you out. We can get the firm to actually cover your cost. And if not, we can actually help you if you're going to be an ambassador for us. So if I'm not the right person, I'll get you in the right hands. No matter what, we're going to take care of you to get you dialed in on what you need, wherever you are. If you're at a university, if you're at a firm, or if you're using another vendor, we can help you out.
Come on, man, we make studying fun. Let's go. You can also email our director of firm partnerships, Quinn. That's Quinn. So Paul or Quinn. Paul, we like Paul better than Quinn. Quinn's okay. You know, we're looking to replace him. Not so hard to do, shoes to fill. So Paulie's our man. All right, Quinn, you know where he is today? Yeah, I think he's out fishing. What's going on with that? He's the sales guy. He didn't want to sit through consolidations. He didn't realize it was going to be a celebration. Come on, Megan, any questions?
He did not know how fun this Saturday was going to be. I bet he's regretting his post right now.
That's what I'm saying. And not that I hope his boat sinks or anything, but if it sunk, I wouldn't be so sad. Megan, any questions for me?
Not today. We knew you were going to, you know, answer everybody's questions as you went.
All right. So look, man, really, you know, studying with us, this doesn't have to be brutal. I kid you not. You know how nuts this is? Megan, myself, Roger, Amber, we get this all the time. People say, you know, they actually miss the lectures when they're done studying. Like, you know, and then I'm thinking they probably need some psychiatric help. So I'm hoping they have good health insurance at their firm. But they actually miss the lectures, man. I kid you not. So don't let them read PowerPoints to you. Why do you want to be with a course that's going to read PowerPoints, that doesn't believe in fun, that likes to edit out things like my legs? Look at these legs. They edit out like, you were show my legs. They're proud of my legs. They don't find my legs offensive, do they, Megan?
And that's true. We let you have pictures with your legs, Pete. That's true.
I'm going to take my medication now. As you can tell, I haven't taken it today. Paulie, anything else?
I think that's what we got. Thanks so much for your time Saturday, spending it here. And we believe in you. We actually can help you get you to pass that CPA with our program and our support. So we have a super high pass rate, and we'll do all that we can to get you there. So make sure you reach out. We'll take care of you.
All right, let's do it. Thank you so much, folks, on behalf of Megan, Paul, everybody else for joining us today, Julie, and all the good people behind the scenes. Thank you so much. Thank you for attending today. And we wish you all sincerely the very best of luck. We hope you earned your business, but regardless, I hope you got something out of today's lecture. Thank you for joining us, and good luck.